Something happened this week that most people scrolled right past. Hundreds of millions of dollars poured into Bitcoin exchange-traded funds in a single day. Morgan Stanley's own Bitcoin fund kept adding coins. BlackRock kept adding coins. Fidelity kept adding coins. And Bitcoin fell anyway. Not crashed, not collapsed, just quietly, stubbornly, kept sliding lower while the so-called smart money kept buying in public view. If you have ever looked at a headline that said, "Institutions are buying," and then watched the price do the exact opposite, you already know the feeling I'm talking about. It feels like the numbers are lying to you, or like you're missing something everyone else already understands. Stay with me for the next 20 minutes, because by the end of this video, you're going to understand exactly why that gap exists, who is quietly selling into all of that institutional demand, and what you actually need to watch next, instead of the headline number everyone else is staring at. Before we go further, a quick disclaimer. Nothing in this video is financial advice. I'm not telling you to buy, sell, or hold anything. This is market analysis and commentary for education purposes only, using publicly available data. Always do your own research and speak with a licensed financial professional before making any investment decision. Now let's get into it. On the 14th of August, 2026, Bitcoin exchange-traded funds pulled in roughly $850 million in a single day, according to Bloomberg data. $850 million. That is not a small number. That is the kind of number that, on paper, should send a very clear signal to the market. Buyers are showing up, and they are showing up in size. And yet, on that very same day, Bitcoin was trading around $62,900, sitting below every single major moving average on the daily chart. The Fear and Greed Index read 29. That is fear territory, not greed territory. The broader crypto market had slipped almost 1% in 24 hours, even as this wall of ETF money kept arriving. So here's the question I want you to actually sit with for a second, not just hear and move on from. If $850 million is flowing into Bitcoin funds in a single day, why does the chart look like nobody wants Bitcoin at all? Comment below if you have ever seen a headline like that and thought, wait, this does not make sense. I want to know I am not the only one who stops and questions these things, instead of just accepting the number at face value. This is not a random blip either. Morgan Stanley's own Bitcoin product, trading under the ticker MSBT, has been part of this exact same pattern for months. The fund launched on the 8th of April, 2026, on the New York Stock Exchange ARCA, and it has been one of the more remarkable stories in this entire ETF era. In its very first month of trading, MSBT recorded 0 days of net outflows, not one single day. 17 days of inflows, 5 flat days, and not a single redemption. By early May, it had already pulled in roughly $193 million in net new money. By the final week of July, that figure had grown to around $431 million in cumulative net inflows, according to data from Farside investors. And by the beginning of August, Arkham on-chain data showed Morgan Stanley's fund on a 3-day buying streak, pushing its total Bitcoin holdings past 6,500 coins, worth more than $426 million at the time. Read that again, because it is worth sitting with. A major Wall Street bank, not a crypto exchange, not a retail trading app, a Wall Street bank, was steadily accumulating Bitcoin for its clients week after week, even while the broader market was struggling to hold its footing. So is Wall Street quietly buying while somebody else is quietly selling? Is the ETF number simply being misread? Or are we watching the early stages of something bigger, a genuine shift in how institutional Bitcoin demand actually works underneath the surface? By the end of this video, you will have your answer. But I promise you, it is not the simple answer most people assume. Here is where this story gets genuinely interesting, because Bitcoin does not trade in a vacuum, and it never has. Morgan Stanley represents the oldest kind of capital there is. Pension advisors, wealth management clients, brokerage accounts that have existed for decades. When a firm like that builds a Bitcoin product, and that product pulls in real client money month after month, it sounds like it should be unambiguously bullish. More demand should mean higher prices. That is basic supply and demand, right? Except price action is never determined by one fund or even one category of buyer. ETF inflows can exist at the exact same time as selling pressure somewhere else in the market. Both things can be true simultaneously. And one of those two forces can absolutely overwhelm a headline-sized ETF number, even a really impressive one. I'm not going to tell you which force wins yet. Stay with me, because the next part is genuinely crucial to understanding everything else in this video. Let's slow down on that $850 million figure for a second, because before we call this an $850 million Bitcoin buying spree, we actually need to understand what that number represents. There's a real difference between ETF share creations, net ETF inflows, actual spot Bitcoin purchased on an exchange, secondary market trading of ETF shares between existing investors, and the total Bitcoin currently sitting inside a fund's custody. A headline can say inflows without telling you whether that money represents brand new capital entering Bitcoin for the first time, or capital simply rotating from one product to another, or even existing holders moving assets between custodians for entirely unrelated reasons. ETF flows are a signal. They are not a guaranteed one-for-one explanation for what Bitcoin's price does on any given day. But even once you account for all of that nuance, there is still a real question sitting underneath it. Why would institutions be willing to commit hundreds of millions of dollars into these products while Bitcoin itself keeps trading under pressure? That is not a rhetorical question. I genuinely want you to think about it as we go through the rest of this, because the answer changes how you should be reading every future headline like this one. Here's a way to picture it. Imagine pouring $850 million into one side of a bathtub, while billions of dollars in trading volume are simultaneously moving out through the drain on the other side, from spot selling, from derivatives unwinding, from leverage getting flushed out. The water level does not rise just because you opened one faucet. It only rises if what is coming in is bigger than what is going out. That is the entire story in one image. Keep that bathtub in your head, because we are coming back to it. Now we get to the real mystery, and this is the section most people watching financial news completely skip over. The question is not simply who is buying Bitcoin right now. The real question is who is selling into them. Because for every buyer on the other side of a trade, there has to be a seller. Somebody is handing over their Bitcoin to Morgan Stanley's clients, to BlackRock's clients, to Fidelity's clients. Who? A few real candidates. Long-term holders who bought years ago and are simply taking profit while institutional bids are strong and reliable. Bitcoin miners who have real operational costs, electricity bills, equipment financing, and sometimes have to sell coins regardless of what the price is doing that day. Large individual holders, sometimes called whales, who can distribute significant positions directly into fresh institutional demand without moving the price as violently as they would on a thin retail order book. Arbitrage desks that exploit small pricing differences between ETF shares, futures contracts, and spot Bitcoin, and who are moving in and out constantly, invisible to a casual chart watcher. And derivatives markets in general, where leverage can amplify what looks like a small underlying spot, move into a much larger price swing in either direction. If the combined selling from all of those sources is larger than the headline ETF buying, Bitcoin can fall even while institutional demand looks incredibly strong on paper. Both stories are true at once. That is the part that trips almost everyone up. Here is a concrete, real number for you. On the 4th of August, 2026, Arkham reported that BlackRock's Bitcoin fund alone bought approximately $111 million worth of Bitcoin in a single session. Fidelity added about $33 million. Franklin Templeton added roughly $9 million. Combined, those three funds alone absorbed around $153 million in Bitcoin that day, and reportedly, none of the tracked funds sold anything. And Bitcoin still could not hold its footing in the sessions that followed. If even that much institutional buying from three separate major firms on the exact same day was not enough to lift the price and hold it, that should tell you something about the sheer scale of selling pressure sitting on the other side of the market. How is the weather where you are right now, by the way? I always like to know who is actually watching these all the way through, because the people who stay for the real analysis, not just the headline, are usually the ones who end up understanding markets the deepest. Drop your city or your weather in the comments. I read every single one. Let's zoom out from the day-to-day noise for a moment, because something structural has genuinely changed, and I think it explains a lot of this confusion. Before spot Bitcoin ETFs existed, the path into Bitcoin was simple. An investor opened an account on a crypto exchange and bought Bitcoin directly. Now, for a huge and growing share of institutional money, the path looks completely different. An investor works through their brokerage account, buys shares of an ETF. That ETF is managed by a custodian, and the investor never actually touches Bitcoin themselves. They own exposure to it. That distinction matters more than people realize. Bitcoin is increasingly becoming less of a crypto-only asset and more of a Wall Street balance sheet asset, sitting inside retirement accounts, wealth management platforms, and registered investment advisor portfolios, right alongside stocks and bonds. Morgan Stanley's own numbers back this up. The firm has roughly 16,000 financial advisors overseeing something in the range of $9.3 trillion in combined client assets. Even a tiny fractional shift in how those advisors allocate client money toward products like MSBT could move enormous sums into Bitcoin exposure over the coming quarters, completely independent of what retail crypto traders are doing on any given day. This creates a genuinely strange possibility. Bitcoin could receive enormous real institutional demand without producing the explosive price reaction that investors have been trained to expect from years of crypto cycles. The old playbook, big money enters equals price rockets, may simply not apply the same way anymore now that the buying is slower, steadier, and routed through completely different pipes than it used to be. This is where it gets really concerning for anyone still trading Bitcoin based purely on old assumptions from 2021 or 2023. The market underneath your feet has changed shape. Are you actually accounting for that shift in how you think about this asset? Or are you still reacting to headlines the same way you did a few years ago? Genuinely think about that for a second before we move on. Here's a question worth asking directly. Why does Morgan Stanley's move even matter when BlackRock's fund still dominates the entire institutional Bitcoin conversation and controls the largest share of total Bitcoin ETF assets in the world? Because the real competition here may not be about who can accumulate the most Bitcoin. It may be about something much bigger sitting underneath that. Distribution, investor access, fee structures, existing relationships with financial advisors, placement inside wealth management platforms that regular investors never even see. Morgan Stanley's fund charges a sponsor fee of 0.14%, which puts it among the lowest cost spot Bitcoin products available anywhere. And that pricing decision alone is a direct shot at the competition, not at Bitcoin's price. The bigger battle here may not really be happening on the Bitcoin blockchain at all. It may be happening inside America's multi-trillion-dollar wealth management machine, where firms are fighting over which one gets to be the default door through which client money walks into Bitcoin exposure. That is a completely different battlefield than the one most Bitcoin content creators are talking about. Hit like on this video if this is the first time anyone has actually broken this down for you this way, because I promise you, most channels are not connecting these dots. Let's talk about the actual educational core of this entire video, because this is the part that will change how you read every single ETF headline from here forward. There are three ways people typically interpret a big ETF inflow number. The bullish read says large contributions clearly signal strong institutional demand, full stop. The bearish read says that demand can simply be absorbed and matched by an equal or larger wave of sellers, meaning the price barely moves at all. And the more neutral, nuanced read says flows might just reflect portfolio reallocation, money shifting from one product or one asset class into another, rather than genuinely new capital entering Bitcoin for the very first time. The real signal is not simply whether money entered an ETF on a given day. The real signal is whether that demand is strong enough to actually overwhelm the available supply sitting on the other side of the trade. Demand against available supply, filtered through market liquidity, that combination is what actually decides price, not the headline number by itself. This is where it gets really concerning if you are the kind of person who trades or invests purely off headlines, because headlines almost never give you that second half of the equation. They give you the exciting number and leave out the boring, crucial context that actually determines what happens next. This next part might be the single most important concept in the entire video, so stay with me here, because I want this one to actually stick. Bitcoin's price can move dramatically when liquidity becomes thin, meaning there simply are not enough active buyers and sellers sitting at nearby price levels to absorb a large order without moving the price sharply. Picture it playing out step by step. A large buyer shows up. A seller quietly absorbs that order. Price barely moves at all because the seller had plenty of Bitcoin to offer at that level. More buyers keep arriving. Eventually, available supply at that price level starts to run out. And once supply genuinely disappears, price can suddenly and violently accelerate because there is nothing left standing between buyers and a much higher price. Now picture the exact opposite happening. Buyers start to weaken. Liquidity on the order books thins out. Leveraged positions, bets made with borrowed money start getting forced to unwind. Liquidations begin to cascade, one triggering the next, and Bitcoin can drop quickly, not because demand vanished entirely, but because the wrong side of the market suddenly ran out of liquidity to absorb the selling. Sometimes the market does not move because nobody wants Bitcoin anymore. It moves because the wrong side of the trade suddenly runs out of room to breathe. That single idea explains more sudden Bitcoin price swings than almost any other concept in this entire space, and almost nobody outside of professional trading desks talks about it clearly. Let's zoom out one more level, because Bitcoin does not exist independently from the rest of the financial system, no matter how much some corners of crypto Twitter want to pretend otherwise. Federal Reserve policy expectations, interest rates, the strength of the dollar, treasury yields, overall risk appetite across equities and credit markets, all of it bleeds directly into how Bitcoin trades on any given week. And here is the genuinely strange part. Wall Street can become more structurally bullish on Bitcoin as a long-term allocation, while simultaneously becoming more cautious about risk assets in general in the short term. Those two positions are not actually contradictory. Institutional investors can want long-term Bitcoin exposure while also actively reducing leverage and short-term risk-taking at the exact same time. That is genuinely the contradiction sitting underneath everything we have talked about so far in this video. And it is why the next real move in Bitcoin's price may depend far less on the next single ETF headline, and far more on what happens to liquidity conditions across the entire financial system in the weeks ahead. Let's lay out 3 realistic paths from here, because I think this is genuinely more useful to you than any single price prediction I could throw out. Scenario 1, bullish absorption. ETF demand keeps arriving steadily, the pool of willing sellers gradually gets exhausted, liquidity conditions improve, and Bitcoin's price eventually catches up to what institutional flows have been signaling all along. Scenario 2, quiet distribution. Institutions keep buying through ETF products like MSBT and IBIT, while existing long-term holders keep selling directly into that fresh demand. In this scenario, Bitcoin stays essentially trapped, moving sideways or drifting slowly for longer than most people watching would expect or have the patience for. Scenario 3, a genuine liquidity shock. Macro conditions deteriorate meaningfully, leverage across the system unwinds quickly, and ETF demand simply is not large enough to absorb the resulting wave of selling. In this scenario, Bitcoin falls noticeably, even while institutional inflow headlines continue to look positive on the surface. The most dangerous mistake anyone can make right now is assuming that one bullish number automatically guarantees a bullish price outcome. It does not work that way, and it never has. Not for Bitcoin, and honestly not for any asset with this much daily trading volume moving through it. Which of these 3 scenarios do you think is most likely from here? I genuinely want to know. Type 1, 2, or 3 in the comments, and tell me why. I read through these, and some of the best insight on this channel actually comes from the comments section, not from me. So if the daily ETF inflow headline is not the full picture, what should you actually be watching instead? Here are 5 things, and these are the ones that professional desks actually track, not the ones that make for exciting headlines. Number 1, net ETF flows measured over multiple weeks. Not a single day's number taken in isolation. Number 2, actual Bitcoin spot trading volume, to see whether genuine new buyers are stepping in beyond just the fund wrappers themselves. Number 3, exchange balances, to see whether available Bitcoin supply is moving toward exchanges, suggesting potential selling, or away from exchanges, suggesting accumulation and holding. Number 4, derivatives leverage levels across the market, to see whether excessive fragile leverage is quietly building up underneath the surface again. And number 5, broader macro liquidity conditions, to see whether financial conditions across the wider system are becoming easier or tighter for risk assets in general. If all 5 of those signals eventually start pointing in the same direction at the same time, that $850 million headline becomes far more meaningful than it looks, sitting on its own today. Until then, treat any single day's number the way you would treat a single data point in a much larger ongoing story. Interesting, worth noting, but nowhere near the full picture by itself. Subscribe if you want me to keep tracking these 5 signals for you every single week, because this is exactly the kind of ongoing story where the follow-up genuinely matters more than the initial headline ever does. Let's bring this all the way back to where we started. Why is Bitcoin falling on the 14th of August, 2026, while Morgan Stanley's fund and the broader ETF category keep pulling in hundreds of millions of dollars? Because ETF demand, no matter how impressive the headline number looks, is only ever one piece of a much larger market. The real question was never simply, is Wall Street buying Bitcoin? The real question, the one almost nobody is actually asking out loud, is this. Is new institutional demand genuinely larger than the supply currently being released into the market by everyone else? That reframes this entire story. It is not really Morgan Stanley bought Bitcoin. It is, who exactly is selling Bitcoin to Morgan Stanley's buyers, and why are they willing to sell at these levels right now? That might be the single most important Bitcoin question that nobody in the mainstream financial press is actually asking this week. $850 million sounds like an enormous, unambiguously bullish signal sitting there on its own. But if Bitcoin keeps drifting lower while institutional money keeps arriving through the front door, the market is quietly telling you something far more complicated than any single headline can capture. Either the buyers are being genuinely overwhelmed by a bigger wave of sellers than anyone is publicly tracking, or the market is in the middle of a much larger structural transition in who actually owns Bitcoin and how they access it, one that will take months, not days, to fully play out. If the next round of institutional flow data confirms this same divergence, we may find out very quickly whether what we are watching right now was simply temporary, ordinary selling pressure, or the early stage of something considerably bigger unfolding underneath the surface. One last thing before you go, what are you actually doing while watching this video right now? Are you checking your own portfolio at the same time? Are you just relaxing after work, or are you genuinely trying to learn how all of this fits together? Tell me in the comments, I promise I read them, and it genuinely helps me shape what we cover next on this channel. If this video actually helped the ETF headlines make more sense to you, hit like and share it with somebody who keeps asking you why Bitcoin is not going up despite all the good news they keep seeing online. And if you want to keep following where institutional money is actually moving, not just where the headlines claim it is moving, subscribe to the Wealth Continuum. I will see you in the next one.